first guest for today. Joining me is Feroze Azeez, who's the Deputy CEO at Anand Rathi Wealth. Great to have you on the show, Feroze. As usual, I want to check in with you. Last week, we saw the Nifty, down by about 2.5%, 6 incessant days of selling, but Friday was a bounce. Going forward, do you think that this was a dead cat bounce, or do you think, the worst of the selling is perhaps behind us?
Good morning, Nanda. Point one, yes, like you rightly said, we had 6 successive days of market correction. But if you look at it, it was also the month-end expiry. 26th October was the last Thursday of this month. When you saw the kind of carnage in the market, which is consecutive days, you also like to see what kind of roll cost happened in that expiry. If you see the roll cost or the futures ended at premium, November futures ended at a premium about 120 rupees, which is marginally more than the cost of carry from a treasury bill perspective. So that automatically said that we were oversold, and that's why the bounce, point one. Point two, when it comes to markets, people generally digest the gains which have come in the past. But if you look at, we are just about 6.6% lower than the peak. If you look at the last 22 years, 23 years of history, the drawdowns every year average have been 14, with 4.8 being the minimal. So I don't think this is a correction which is substantive enough for a person to be worried from a investor standpoint. Because if you're looking at the average of the last 22 years, leaving the GFC, which is the global financial crisis, and the COVID years, which were exaggerated years, you leave them apart and there's a 14% drawdown from peak to trough each year. And if you include them, then the drawdowns go to almost about 17-18% average a year. So I think we are not in any zone of a sensible correction, I would say, because 6.6% from the peak is not such an exaggerated move from a profit booking standpoint.
Right. Speaking about the earnings season now, Feroze, since we are in the midpoint of the earnings season on mid-caps, when we see some kind of correction, of course, mid-caps are the ones that bear the brunt of that correction, right? So what are you advising your clients in terms of, stock picking? Would you say time to stick to large caps, perhaps, or even look at some of the mid-caps with good fundamentals? What are you advising your clients now?
Yes, Nandana, I personally think we've oversimplified the mid-cap and small-cap category. It's a very large universe. So if you look at large caps, you can be very generic when you're speaking about the top 100 companies of the country. But if you look at the mid-caps, especially from mutual fund investor standpoint, it is the Nifty 150 mid-cap. The formation of the index itself is reasonably complex, and I think it's little known that why in the NSE 500 or the small-cap 250 index, there is a 4,000 crore market cap, and some company with a 8,000 crore market cap is not even in the top 500. Because the formation of the index, if you look at the formula of it, a company needs to be in the top 350 to form a part of a 500. So I personally think index in the small cap and the mid cap index have generally been lagging behind because the way they are constructed has a lag impact of several businesses doing very well and then they're getting included and a person missing out the rally. So point one I'm trying to make is if you have to be in the mid cap is still okay. If you have to be anywhere close to small cap, the name of the game is to be very specific and at least understand how the index is constructed. If you look at the top 10 weights of the index, they're about 16-17% if I'm not wrong. So I would say a concentrated top index bet is a better strategy in the small cap space. That's one thing which I'm saying on the basis that most index fund investors itself don't know the logic behind a 3,000 crore being a part of NSE 500 and a 6,000 crore company not being a part of NSE 500. That's because a company, if it has to find itself